Hello and welcome to Insights Exchange. I'm Bruce Whitfield. It's brought to you by Private Clients by Old Mutual Wealth. Three fabulous guests for you today. Andrew Dittberner, the Chief Investment Officer. We've got Victor Mapunga. He is the Head of Research, and Research Analyst Tasneem Samodine is with us too. And we're going to look at investment opportunities around the world. And first up to Andrew Dittberner, the Chief Investment Officer at Private Clients by Old Mutual Wealth. South Africa's had a rough year. Global markets have been pretty choppy, but American markets have been astonishing, actually, Andrew.
Yeah, I think, if you had to go back 6 months, I don't think anyone would have guessed, what markets, particularly the US markets, have done this year. So we've had the everything bubble, I suppose, that took place through, the early, the 2010s, early 2020s. And I think last year was probably, healthy for markets. Couldn't keep going up for forever and a day. And this year, I don't think too many people would have expected to see markets up, 16-17% at the mid-year mark. And it seemed to all come from, the beginning of March, when we had that so-called banking crisis, where a couple of big banks, as we know, fell over. And I think all of a sudden, market participants thought, the Fed put is back in play. The Fed's going to protect markets, they're going to put money in, save the banks. So many of these companies that you think might do poorly in rising interest rate environments suddenly started to do well. And we know which companies those are. Markets are very good, or investment participants are very good at making up these acronyms, FANGs, and now we've got the Magnificent Seven.
We'll talk about the Magnificent Seven in just a bit, because FANGs was lovely as a theme for a while, but I think the Magnificent Seven may be more appropriate into the future. The collapse of Silicon Valley Bank, which was the first one. Very few people outside of Silicon Valley, outside of California, would probably have heard of Silicon Valley Bank. Suddenly it was world news. It turns out it was actually a very substantial banking operation. There was a fear of contagion. There were one or two other banks, and suddenly Credit Suisse got itself into trouble in Switzerland. There was almost a sense that markets were looking for an excuse to catastrophize just a little bit. It went for a while, but the state, once again, stepping in, the US Fed stepping in, calmed everybody down.
It went for a little while. I think that was a few days.
Yeah.
And, coming into this year, the mindset of investors, I think, had changed somewhat. There's been that fear of missing out that we've spoken about. Again, another acronym that the market's come up with over the last 10, 15 odd years. And I think coming into this year, we had, a fear of losing money. People didn't want to lose money given what had happened last year. And suddenly with the Fed coming back in and looking after, the banking system, let's put it that way, suddenly this FOMO investing is back, and, things seem to feel okay. But as I say, when you start to get comfortable, when complacency sets in, I think that's when we've got to be on our toes and wary, particularly of valuations.
When it comes to valuations, and one then looks at the FANG stocks, nothing was going to hold back the FANG stocks during 2021 and 2022. They were defying gravity, and suddenly logic did prevail. Why does it take a crisis to precipitate logic in markets? It's infuriating, because you want to ride the biggest trend in town, but you also don't want to get caught short when the trend ends and you're the last one holding some shares.
Exactly. Yeah, we're in this strange market where I think, bad news sometimes becomes good news. And I think that's what happened in March. So up to March, markets were fairly flat this year. And, suddenly you see for the next 4 or 5 months, markets have absolutely taken off. And there's this new, I suppose it's the unexpected theme, that's popped up at the end of last year, ChatGPT, artificial intelligence, and now suddenly you've got all of these companies, these technology, let's call it technology-facing businesses that we think are just going to, be the absolute winners in, and keep growing earnings forever and a day.
But that becomes the same nonsense as the meat replacement businesses and all of these things where the market attaches itself to a hypothesis which has long-term viability. Of that there is no doubt. But in the short term, the mispricing that happens is dangerous for investors.
I've lost track of what Nvidia trades on. I mean, I think it's like a price earnings multiple of 200 or 300 times. We can go back to the dot-com bubble, the 2000s, when we saw, a company like Cisco jumps to mind. Fantastic business, and that's where you've got to be careful about getting a business and an investment mixed up. A great business, But if you bought Cisco in the late 1990s, early 2000s, it took you 20 odd years to break even, because you're buying it on a multiple of whatever it was back then, 100, 200 times. NVIDIA's in the same place. Great business. Their chips are used everywhere. I was watching a video yesterday about John Deere. They sit in John Deere tractors, that have videos to spot weeds, in farms. They are everywhere. But are they going to grow into that multiple over the next year, 2 years? It could take a lot longer, and that's what we.
And so, how do we avoid getting caught in these traps? Because it is like tap dancing through a minefield at the moment. Because that's when reality checks happen.
Yeah. So you just got to, I suppose, look at, as I say, valuations. But there's fantastic businesses out there at the moment, high quality companies that have been, this market has absolutely left behind. So don't get caught up in the hype and the enthusiasm around, many of these shares. And it's not just going to be the technology-facing companies that are going to benefit from this, artificial intelligence theme revolution, whatever it turns out to be in the next 5, 10, 15 years' time. Old economy type businesses, I mentioned John Deere earlier, there are many others, Honeywell, the list goes on, that are going to benefit from, what is happening, from this artificial intelligence, machine learning theme that's taking place. Old economy companies are digitizing. They're going to become more efficient with time. As a result, they become more profitable, and their earnings will also grow. And that's going to be good for the whole economy, not just a handful of 7 companies, as we referred to them earlier.
Now, okay. Now, talk to me about the Magnificent Seven. I mean, is there anything in the Magnificent Seven that is magnificent from an investment perspective right now?
Yes, look, I think,
Who are they, by the way?
Magnificent Seven, now you're going to, it's Apple, Microsoft, Alphabet, Google.
So FANGs, basically, with a new name.
NVIDIA, Tesla, and I'm leaving out one.
Okay.
You're going to help me. Amazon, there we go.
There we go.
I think, they are fantastic businesses, and I think there's still some really good investment opportunities within those. You don't want to go and pay 200 times for NVIDIA, but I think, you've still got the likes of your Apples, your Alphabets, your Microsofts. Yes, they could be slightly on the wrong side of fair value, but I'd be willing, to bet my house that if you invest in them today and you've really got a long-term mindset, so you're going out 10, 15 odd years, I'm sure they're going to be worth a hell of a lot more.
I mean, if you look at the weighting of Apple in Berkshire Hathaway, for example, it's become a very substantial portion of the value of Berkshire Hathaway. To my mind, that's a huge risk for any retail investor who goes and buys themselves 10 Apple shares. Because if Buffett decides he's getting out, or his successors one day, if he ever dies, decide that they're getting out of Apple or reducing their stake in Apple, there's a threat of an overhang in there. Because there's a very substantial stake within Berkshire.
I think Apple probably makes up about 30%, I think, of the Berkshire investment holding business.
And it's been quick, because he was late to the party, and it's gone from 2 to 3 trillion in the meantime.
So I suppose one of the criticisms against Buffett has been his reluctance to invest in these tech shares. He went into Apple. He's called it, I think, his best investment that he's ever made, and it really has driven Apple. But the concentration is not just within Apple. The concentration sits within the market now as well. We see, I think these 7 shares account for 30, 40% of the S&P 500. You're actually not getting as much diversification as you think you are, because you're heavily geared towards these very, very large businesses. What's Apple now? $3 trillion.
No, exactly. So then when it comes to your philosophy and the way you construct portfolios, okay, so we talked the big macros and the markets, and they've done fantastically well, but you don't necessarily get great market opportunity by following the herd. The opportunity comes in being able to define what is undervalued, going for a proper long-term value perspective on this. How are you thinking then on shaping client portfolios into the future?
So we build segregated portfolios, and I think that's very different to managing a fund or a unit trust.
Absolutely.
So more concentrated. Typically our portfolios will be between 20, 25 shares at most.
And this is out of a worldwide universe of millions of companies.
So, millions, global equity, a few less than a million locally. But we're picking, 20 to 25 shares, whether it's a local, global portfolio. So fairly concentrated positions. Simple maths will tell you that's 4 to 5% exposure to each holding. So we don't have a long, holding of very, very small weights in the portfolio that effectively become meaningless over time. We're not a value manager, so we're not looking for deep value type businesses. We're looking for good, solid companies, what many people refer to as a quality business, and how do you define quality, that have good management teams, that allocate capital effectively and efficiently. Balance sheets are strong, they're generating real revenue, backed by cash, not backed by some accounting principle or accruals. Margins, sustainable, all those sorts of boxes that we look to tick.
Good old-fashioned investment,
absolutely.
Good oldfashioned investment practice.
One's got to remember when you're building a segregated portfolio, we can't chop and change shares tomorrow because the end client has a tax implication as a result. So if you look at our turnover, our portfolio turns over about 10% per annum. So again, that will tell you average holding period 10 years plus. So very long-term patient. We're willing to pay a fair price. We pay attention to valuation. But
it's not valuation at all costs, though.
Yeah, absolutely. We're not looking to find that, Buffett used to call them the cigar or the deep value type shares. Rather, we'll pay a fair price for what we think is a good business. Obviously, if it comes cheap, or comes attractively priced, that's about.
Everybody's looking for those, though. So how then do you identify what is reasonable and attractively priced in a market where there are thousands of people like you all over the world chasing the same idea?
So we'll ask a simple question about what is the market price in this business to do over the next 5 years, 10 years, and do we think, that's a reasonable assumption? If you look back over time, not too many businesses have been able to grow earnings 20% per annum for 10 years. Very few. I could probably name them on one hand and have a few fingers left to spare. So if you find a business, put in some basic assumptions in what can this business generate, what has it done in the past, what have the management team, have they demonstrated the ability to allocate capital and grow businesses, whether it's in this company or in a previous business, and ask a couple of simple questions. We're not trying to reinvent the wheel here. Good businesses, pay a fair price, and the market will take care of it over 10, 15 odd years.
In the short term, markets are driven by the fear and greed. They're driven by noise factors within the market. They're driven by hype, by trends. How do you tell the difference between what is a signal? In other words, here's something real. AI is here, it is here to stay, and it will adapt and can only improve from here, versus here is a meat-free burger that is going to change the way meat eaters consume their protein in perpetuity, because clearly that was rubbish. How do we know that the AI story that is brewing at the moment is not equally bunkum?
Look, I think artificial intelligence has, this isn't something that popped up overnight by someone left field that we had never heard of before. I think this has been something that's been spoken about. Companies have been investing in it for a very, very long time. If you look at technological revolutions, and I'm not saying this is the next one, but it potentially could be. And if you look back over time, they typically come around every 50 odd years. You can go back to Arkwright's mill in the late 1700s. And every 50 years you tend to see, then it was the steam train in the early 1820s. Then you had the last one was the Intel microprocessor in the 1970s. So I'm not relying purely on that, but we are ripe for some sort of revolution, technological revolution that could have a very long-lasting impact on not just markets, but actually on the economy as a whole. And when you look at the adoption of artificial intelligence, if you just look at the number of companies, not even tech companies, I think JP Morgan today has 1,500 employees that are working within artificial intelligence. I don't think this is a short-term fad that's going to disappear tomorrow.
And so, how then do you control your investors? Because your investors come to you and say, I want a portfolio. I agree with you. 20 to 25 stocks, that is optimal. But you know what? I want to ride the Magnificent Seven. I like the theme. I like the story. And you say to them, no. Yeah. We're not going to fall for that trap. And the Magnificent Seven continues on its rally and it adds another 20%. And you start looking like the guy who missed the boat. So, it's a tough balancing act, isn't it?
No, it absolutely is. Clients need to understand the philosophy. They need to buy into the process. That we're building portfolios. It's long term. We're not chopping and changing. We're not trying to take part in the next fad. Whatever that might be. We want to really invest in those great businesses.
So, I mean, your clients have got investable assets of at least 3 million rand and north of that, which gives them this wonderful opportunity to access a world of opportunity. What is that world of opportunity as a South African with rands to access the globe? What do you see as the big opportunities?
Yeah, so I mean, look, you say 3 million rand, you can't go and build a segregated global equity portfolio just from a size. When you look at the price of some of these companies, I'm not talking about valuation, I'm talking about price per share. So you need about 3 million rand, and the opportunities, as you say, are just far superior globally than what you can get locally.
I think I'm going to pick on Victor on this one, because Victor is thinking very deeply, isn't he, about the global opportunity set?
He's the lead portfolio manager on the global equity portfolio, so I'm sure he's got some fantastic ideas.
I'm going to let you go,
okay.
And I'm going to bring Victor in to sit in that very warm seat that you've created for us. But thank you for your perspective, global perspective on markets and the way in which markets are evolving, the changing, the landmines, the dangers, and the huge opportunity set that exists in global investment markets for you as an investor. Victor is coming up next.